Hey guys, Cam McLellan here. I'm here today dressed like this because I'm setting the stage for the biggest title fight, the showdown of two financial giants, property and shares. I'm sick of the jibber jabber of which investment is better. So today we're going to sort it out once and for all. We're going to put an end to this argument. Second reason I'm dressed like this, the reality is I've got nothing better to do with my time, so this keeps me amused. I want to talk about the two investments. When we're looking at each investment, when I'm not dressed like an idiot, I'm looking at and understanding what the risks and return is of both investments. So when I invest in property, I understand the markets, the area and the individual property, so I know I'm making smart investment choices time after time. I compare that to the risk and return versus a share investment or diversifying across or giving my money to a share-centric fund manager and letting them spend my money for me, and I look at the risk versus return of that investment. Saying that, I do own shares in companies, but the companies I invest in, I look at the balance sheet, the profit and loss, the cash flow. I understand the management team, the strategic strategy of what that company is doing, the competitive nature of that industry, and I invest and I buy chunks of that company. I don't diversify across a share market or give my money to someone else to invest in. Understand where you're putting your money and make the decisions yourself. So, when I look at the risk versus return, and while we're comparing it, a lot of people will say that shares will outperform property dollar for dollar. And that is true. I agree that sometimes, and on a mass scale, you could say that shares maybe 10% increase annually per year, property around 8.7% it is, I think, something like that. So I'll rip these off just for a minute so I can actually write and do some work here today. So, what I've looked at, when we invest, we know we use other people's money, OPM. That's the main thing. We don't invest dollar for dollar. So we take our money, we leverage our money from the bank, and then we maximise the loan to value ratio of whatever investment, and then we invest in a market. So thinking back to the risk versus return, I've got here from my private banker at Westpac, the BT margin lending, the current one, and I'm looking at the security. So the loan to value ratio that Westpac or BT will allow me to leverage and invest in share market. When I'm looking through, there's some investments, some shares that I can leverage up to 70, a couple here at 75%, the most of them around the 40 to 50% mark. So it seems from this at a quick glance, the majority of lenders will lend at about a 50% LVR on shares. That's probably a safe bet if you're looking at it, if you think of the GFC and compare that to, property at 90, 95%. So understanding that loan to value ratio, and looking at the bank's own risk assessment of property versus shares, the banks deem shares to be near twice the risk of property investment. I probably agree with that based on the GFC. If we think back to 2008 onwards, shares dropped to about 45%. There was a lot of margin calls and a lot of very sorry people at that point in time who'd invested heavily with their super funds or invested in the share market. Medium density property under the median house price in our capital cities dropped about 10%. So it's probably safe that if you were to leverage up on shares, 50% is probably the max that I'd even consider. Where property, I'd take it as far as I could. So if we look at those investment or leverage ratios when investing in a market, and I'll do a little exercise here for you because this is going to sort this argument out once and for all. If we look at this in dollars, so we've got say 500k, 1 mil, 2 mil, and we take this is time at the bottom here, we'll say that's 20 years. 20 years of investing. If I take shares and I leverage up, and say I've got $50,000, let's say we've got $50,000, and I take shares and I leverage that up, what I'm investing in the market is $100,000. The bank will give me 50, I've got my 50, so I'm investing 100k into the market. If I give shares a 10% yearly increase in value over a 20-year period, that 100,000 will end up at about 610k, 611,000, I think, off the top of my head. If I take that same $50,000 and we go conservative, we take it at 90% rather than 95, don't want to push the friendship. At that point in time, our initial investment into the market is 450k. If I give shares the advantage of a 10% increase year on year, and property, we'll give it 8%. At the 20-year mark, there'll be $2.7 million. That's without even leveraging each investment at each point. If we were to leverage each investment at each point when we had equity growth and go again, or to double up our leverage, the difference in property would dwarf shares as an investment. So it frustrates me when people look at shares versus property and compare them as an investment opportunity. The reality is, shares are near double the risk of property, and property will always outperform shares every single time based on the fact that you can use other people's money to invest with. So, $610,000 versus $2.7 million, I think the fight's over, guys.